All right, everyone, settle in. Welcome. Today, we're going to tackle a really important topic, something that's becoming more and more relevant: the tax obligations for commercial ride-sharing drivers here in Canada. I know taxes can seem daunting, but my goal here is to really break it all down for you, step by step, so you walk away from this feeling confident and in control.
Just so you know who's talking, I'm Samir Al-Rashani, and I'll be walking you through this masterclass. All right, let's jump right in.
So here's our game plan for today. Think of it as our roadmap. We're going to start with the big picture. What exactly is this platform economy? Then we'll get into the nitty-gritty, the difference between ride-sharing and delivery services, which is huge for tax. After that, we'll cover your income tax obligations, then your GST, HST obligations. That's a big one. And finally, we'll wrap up with the practical stuff, like how to actually calculate and file your taxes, and, maybe most importantly, how to keep good records.
Okay, first things first. Before we can talk about taxes, we need to understand the world you're operating in. So let's talk about the platform economy and what your role is as a driver. Seriously, getting this part right is the foundation for everything else we're going to discuss.
So this whole system, Uber, Lyft, you name it, it's what we call the platform economy. It's all about these digital platforms connecting people. But here's the absolute number one thing you need to burn into your memory. As a driver, you are considered self-employed. You are not an employee of Uber or Lyft. And that right there, that single distinction is why you, and not the company, are responsible for handling all of your taxes. Your income tax, your sales tax, it's all on you.
All right, let's move on to what I think is the single most critical point of this entire session. This is the one thing that trips up so many people, and it's this: the tax rules for driving people around, ride sharing, are completely fundamentally different from the rules for delivering food or packages.
And why are they so different? Well, it all goes back to a specific date, July 1st, 2017. You should circle this date in your mind. This is when the CRA, the Canada Revenue Agency, stepped in and made a change to the law. They officially said that commercial ride-sharing services are, for tax purposes, the same as a taxi business. And that one little change, wow, it created a whole different set of rules for sales tax that we absolutely have to understand.
Okay, this chart here really lays it all out in black and white. If you look at the top row, for income tax, it's simple. Doesn't matter if you're driving people or delivering pizza, you report your income, you claim your expenses. Same. But look at that bottom row, the GST/HST row. This is where everything changes. For commercial ride-sharing, you see that word must? You must register immediately, from your very first dollar. But for delivery services, you only have to register if you make more than $30,000. That is the critical difference we've been talking about.
All right, so let's dig into the first big piece of the puzzle: your income tax obligations. When you're self-employed, you don't just put a number on your regular tax return. Nope, you have to fill out a special form called a T2125, the Statement of Business or Professional Activities. This is basically your business's income statement for the government.
Now, the great thing about being a business owner is that you get to deduct your expenses. The rule of thumb is, if you spent money to earn your income, it's probably a deductible expense. Think about it. The fees that Uber or Lyft take out, that's an expense. Those annoying toll and airport fees, expense. A portion of your cell phone bill, you bet. Even small things, like if you buy water or snacks for your passengers, that's a business expense. If it's a legitimate cost of running your ride-sharing business, you can almost certainly deduct.
Okay, but let's talk about the big one, the elephant in the room: your vehicle. This is hands down going to be your biggest expense category. But here's the catch, and it's a big one. You can only claim the business use of your car. The CRA is very clear on this. You have to separate the kilometers you drive waiting for a ride or driving a passenger from the kilometers you drive to go to the grocery store or visit a friend. They are two separate worlds, and you need a wall between them.
So how do you do that? Well, you calculate what's called your business use percentage. The math itself is super easy. Just take your business kilometers and divide by the total kilometers you drove all year. Simple, right? The hard part isn't the math. It's getting those two numbers, and that means you have to be tracking your mileage all year long. I'm going to say this again because it's that important. This is non-negotiable. If you want to claim your car expenses, you have to track your mileage.
And here's the recipe to figure out your deduction. It's a simple 5-step process. First, you need your total KMs for the year. Second, your total business KMs. 3rd, you do that little division to get your business use percentage. Step 4, you add up every single vehicle expense you have. Gas, insurance, repairs, new tires, car washes, all of it. And finally, step 5, you take that big total of expenses and multiply it by your business use percentage. Boom. That's the number you can legally deduct on your tax return.
Oh, and we're not done with the car yet. On top of all those day-to-day operating costs, don't forget about the bigger stuff. You can also deduct the business portion of the interest on your car loan, or if you're leasing, a portion of those lease payments. And then there's the big one, something called capital cost allowance, or CCA. That's just a fancy government term for depreciation. Basically, the CRA lets you deduct that piece of your car's value each year as it gets older. It's a huge deduction that a lot of people miss.
Okay, let's switch gears. We've talked about income tax. Now we need to talk about GST/HST, the goods and services tax or harmonized sales tax. And I'm telling you right now, this is the area with the most specific, most strict rules for ride-sharing drivers. This is where people make the most mistakes and where the CRA is looking the closest.
So in the normal world of Canadian business, for consultants, for artists, for most small businesses, there's a concept called the small supplier rule. The general idea is that if you make $30,000 or less in a year, the government says, don't worry about it. You don't have to register for GST, HST, you don't have to charge it, you don't have to send it to us. It's a way to simplify things for very small operations.
And that's the magic number, $30,000. It's called the small supplier threshold. It's one of the most basic rules of business tax in Canada. Remember that number. Okay, you have that number in your head? $30,000. Now, I want you to take that number and throw it in the garbage. Because, and listen closely, this is probably the most important sentence you'll hear today. As a commercial ride-sharing driver, that $30,000 rule does not apply to you. It's completely irrelevant. You must register for GST/HST from your very first trip. From $1. No exceptions, no grace period.
So what does this mean? It means you have a three-part job. You have to register for a GST/HST number, you have to collect that tax on every single fare, and you have to send that money to the CRA. Now that sounds like a pain, I know, but there's a huge silver lining. Because you are now a GST/HST registrant, you get to claim back every penny of GST or HST you paid on your business expenses. The tax on your gas, on your repairs, on your cell phone bill, you get it back. These are called input tax credits, or ITCs, and they can add up to a lot of money.
Okay, so we get it. We have to report our income, and we have to deal with GST/HST. But how does it all actually work? Let's get into the mechanics of how you calculate this stuff and get it filed.
When it comes to your GST/HST, you actually have a choice to make. There are two ways to calculate what you owe, the regular method and the quick method. The regular method is exactly what it sounds like. You track all the GST you collected, you subtract all the GST you paid, your ITCs, and you send the difference to the government. The quick method is a shortcut. You just send in a smaller fixed percentage of your total sales, but, and it's a big but, you don't get to claim most of your ITCs. For most drivers with all those vehicle expenses, the regular method usually works out way better. Now let's talk deadlines, because this is another spot where people get tripped up. It's a bit weird. You actually have two different key dates. April 30th is your payment deadline. If you owe any money for income tax or GST/HST, the CRA wants their cash by April 30th, but they give you a little extra time to get the paperwork done. Your actual filing deadline isn't until June 15th. So remember this little rhyme. Pay by April, file by June. Get that wrong and you're looking at interest and penalties.
All right, we're on the home stretch. But this last topic is arguably the most important. Because none of what we've talked about, not the deductions, not the ITCs, none of it, is possible without good records. You can have the best accountant in the world, but if you don't have the records to back up your numbers, it's all useless.
So think of this as your non-negotiable annual checklist. On January 1st, you write down your car's odometer reading. Period. Throughout the year, you keep every single receipt and you maintain a logbook of your business versus personal driving. An app is great for this. Then on December 31st, you write down the final odometer reading. These bookends, the start and end odometer readings, are absolutely mandatory. And that logbook, that's your evidence. That's your proof if the CRA ever comes knocking. Let me be clear. This isn't a friendly suggestion. This is a requirement of running your business.
So, what's the big idea here? What's the one thing I want you to walk away with? It's this. You have to stop thinking of this as just a side gig. It's a business. Your business. And the moment you start treating it like a serious business, everything changes. Tax compliance isn't just this annoying chore you have to do once a year. It becomes a tool,
a powerful one. It forces you to understand your real costs, to see your true profit, and to get a clear picture of the financial health of your operation. So, are you setting yourself up for success by treating this like the serious business it is, right from day one? I think the answer is obvious.